Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we have a very big problem. The problem we face as investors is the fact that the S&P 500 is at all-time highs, and consequently that must mean that the S&P 500 is incredibly expensive. By extension to that, the big tech companies of today that are the massive constituents of the S&P 500 must be expensive as it stands currently. By the same line of thinking, that means that we as investors need to liquidate our portfolios and go into cash and wait for the inevitable market crash. Because just like the 2000s internet bubble, the AI hype cycle will come crashing down, and so we need to go into treasury bills, all of us. A little bit getting carried away at the end there. Of course, I think you guys understand I'm being sarcastic, but nonetheless, that's a very reasonable concern to have as investors. The S&P is at all-time highs. No matter how you look at it, the valuation seems to be a bit stretched. Just before we continue on, I did want to mention the video is sponsored by Finchat, which you'll hear from later on in the video. If you consider the fact that the average PE ratio of the S&P 500 in the past give or take 100 years has been roughly 16 times, the current 29 times multiple is a little bit ahead of historical averages. Additionally, if we run a very simple screener on finviz.com and we sort by companies that are over a $200 billion market cap threshold, and then additionally we sort them from most expensive PE to least expensive PE, you're able to see that we have a lot of businesses trading at way above a 30 times multiple. And these are not small constituents of the S&P 500. These are multi-$100 billion businesses. AMD, of course, at the top being a very prominent example of exactly this. The trailing 12-month PE ratio of AMD is roughly in the 250 times range. And of course, on a forward basis, it does look a little bit better than that. But nonetheless, most investors, they look at the trailing PE. Additionally, if you look down the list, you'll see healthcare giants like Merck and Eli Lilly. Eli Lilly, of course, being the company behind the GLP-1 and insulin products. Again, if you go a little bit further down the list, you see Nvidia, the third biggest company in the world, 74 PE. And, we could sit here and go through all these different examples all day. Even on the second page, you could see that there's roughly, I want to say about 25 or so businesses that have a PE ratio that are higher than the market average, right? The market average being roughly what, like 29? Yeah, 29 times multiple today. But I think despite all this data, and despite the literal fact that the S&P 500, compared to its historical averages, is extremely expensive, it's still not a bad time to be investing. And in order to prove that to you, I want to point to a research paper by RBC, which is the biggest bank in Canada here. And I'll leave this in the description if you want to read the whole thing. But essentially, they go through and they point to the fact that even though investing at all-time highs might signal that the S&P 500 is incredibly expensive, your absolute returns aren't that far off of investing at literally any other time except all-time highs, right? And they show us in this graph over here, the average 1-year return after investing at all-time highs and literally any other day. So if you invest in any other day other than all-time highs, you roughly average about a 13% return, and this data was gathered between 1950 and 2024, so roughly a 75-year time frame in between there. But if you invest at all-time highs, on average, you have about a 11% return 1 year after that. But what's interesting is if you start to zoom out a couple years outside of that, the discrepancy on a 3-year basis is roughly identical. There's almost no difference investing either at all-time highs or any other day if you look on a 3-year basis. Now, admittedly, the gap on a 5-year basis seems to have widened a little bit more. There's roughly a 1% difference on that front. But I'm willing to bet if you span out and you look at 10, maybe 15-year timeframes, your return investing at all-time highs versus investing at literally any other day is almost identical. There's probably not any difference. Another interesting insight that I was able to pick up from the RBC paper is the odds of you actually returning 10% or greater loss on various different timeframes. So if you invest at the all-time highs in the past 75 years, you have roughly a 9% chance of having a 10% loss 1 year after you buying the S&P 500. Now, what's incredibly interesting is if you zoom out simply 3 years, you go from 1 year to 3 years, right? So you buy at the all-time highs and you wait 3 years. You have only a 2% chance of having a 10% or greater loss. I'm going to repeat that one more time. If you invest at all-time highs today, historically speaking, the odds of you having a 10% or greater loss is 2%. Right? So incredibly low odds, like basically never happens. I would assume the only historical example that we have of that is actually the dot-com bubble, where if you invested at the peak of the dot-com bubble, when it's at like a 40, 50 PE, if you invested at the peak of that, you would have probably returned negative 3 years later, right? So barring the dot-com bubble, it's never happened. And then what's incredible about that is if you actually wait 5 years, there's a 0% chance of you having a loss 5 years later, right? We could see it in the chart right here. And this is, again, according to Canada's biggest bank. This is a very reputable bank with roughly $2 trillion in assets under management. So again, very reputable bank. And they say that the odds of you having a 10% loss 5 years out after buying at all-time highs is 0. There's never been a historical example where you've had a loss 5 years afterwards. And this actually aligns very well with another research paper from Factset. Factset is like a data company, and they grouped up together with JPMorgan, which is America's biggest bank, and their research ran between the years 1988 and 2020. If we just quickly go back to RBC, we could see it's 1950 to 2024, right? So they have a little bit more of old data in there. This is a little bit more recent. So with JPMorgan and Factset's research, they actually came to the conclusion that investing at all-time highs is more beneficial to your returns than not investing at all-time highs. Oftentimes, investing at all-time highs signals bullish momentum into the ETFs and signals that it is part of the good times. And so you start to ride the wave and the bullish momentum into higher and higher returns. This honestly probably makes more sense than RBC's data. I think RBC's data is a little bit more skewed towards data that is before the 1990s and the 1980s and all that type of stuff. I think this more recent data is probably more revealing to us investors, right? So again, take it with a grain of salt, but investing at all-time highs, I don't think you should be scared of that. If anything, you should be looking forward to investing at all-time highs because it signals bullish momentum into the ETFs, into the stocks. And judging by Factset's data, it's actually more beneficial to your portfolio to be investing at all-time highs. So worst case scenario, you underperform a little bit. And best case scenario, you actually outperform investing at any other time, right? Just to give you like an idea into the range of outcomes on that front. So I hear you saying, okay, Arya, whatever the case is, investing at all-time highs, no problems. But the thing is, Arya, I don't just do ETFs. I also like to pick individual stocks. Now, the problem with that is that all the great companies, they're extremely expensive. Sure, the index in of itself is expensive, but you have companies like, for example, Apple or Microsoft or even Amazon. Arya, you love Amazon. All these different businesses, sure, they're wonderful businesses. They have the highest weights in the S&P 500, but they're even more expensive than the index, the combined entity that is the index. So, Arya, I'm running out of ideas. Like, what can I reasonably be investing in, given the fact that the index is at all-time highs? And to answer that, I have two companies. And I have two companies which, honestly, I think these fit the investable universe of every single one of you guys watching. It doesn't matter if you're a dividend investor, a growth investor, a quality investor. It doesn't matter if you do options, right? Like, you could literally be any type of investment style. And I think this fits into your, as long as you're a person that wants to hold businesses for the long term, I think this probably fits into your portfolio somewhere. These are extremely solid businesses. I'm not going to beat around the bush here. Mastercard and Visa, which I know, classic, right? Like very, very obvious businesses to be invested in. These are businesses that have done like 20% CAGR since the dawn of time. Very powerful businesses. Everybody recognizes them. But no, I really want to like hone in on this. I think as it stands currently, especially compared to historical averages, these two companies are relatively cheap, if I do say so myself. So for starters, let's just get the valuation out of the way. And the way we do this is once you go over to Finchat, you search up the company that you're looking at, you could scroll down here, go into ratios, and you have the option to choose between trailing or forward valuation. For now, we'll just go over and you know what, we'll do the trailing PE of Mastercard, right? A very, oftentimes, it's the most cited measure of valuation. And you could see that, you know, this kind of tells a story. And we've seen in the past, give or take 5, 6, maybe even 7 years, that Mastercard has become a more expensive business and it has warranted a higher valuation. And as it stands currently, Mastercard is roughly in the midpoint of the past 10 years of valuation. Another useful feature that Finchat has is if you icon over here, it will give you the average PE ratio or the average whatever you're looking at in the past 10 years. And what's incredible about this is you could actually zoom in to, let's just say, you know what, we want data a little bit more recent. Let's bring it all the way to 2019. So this is showing us data in the past 5 years. And you could see that in the past 5 years, the average PE ratio of Mastercard, so we took the PE ratio of every single day, divided it by the number of days that has been in the past 5 years, the average PE ratio was roughly 41. And it's actually trading at a discount to that PE ratio. Currently, Mastercard has a trailing PE ratio of 36. And you know what? We could run this exact same exercise with price to free cash flow. You guys know I absolutely love price to free cash flow. I think free cash flows is what you own as an investor. That is how they issue dividends out to you. That's how they buy back shares. That's how they pay down debt. When they do acquisitions, they're using the cash that has came into the business, not necessarily the net income. And there's a lot of toying around that you could do with net income and the PE ratio consequently, right? So if we were to simply toggle on the price to free cash flow and we hide the PE ratio, we could run the exact same exercise with the free cash flows of this business. Again, going to the gear icon, pressing the first option there, we were able to see that the price to free cash flow historically has been roughly 39 times. Mastercard trades at a slight discount to that. And again, this is the past 5 years. If we expand this data to include the past 10 years of data, you can see that it actually trades at a slight premium to the 10-year historical average. So again, roughly about the historical average, maybe a little bit over, maybe a little bit less. But as you can see, like it's pretty fairly valued compared to the historical of the business. But what you have to ask yourself as an investor is Mastercard more predictable today than it was 10 years ago or 5 years ago? I would argue the answer to that question is absolutely yes. As time goes on, the network effects created by Mastercard's business are going to be progressively getting stronger and stronger. Mastercard, a business that benefits from both the merchant side of the equation and the consumer side of the equation. As there's more consumers around the world using Mastercard, more merchants will want to accept Mastercard and consequently Visa. Everything I've said in the past 5 minutes could be said about Visa as well, right? So as more consumers use Mastercard, more merchants will want to accept Mastercard and Visa. And it works the other way around. If you as the consumer know that everywhere you go, you could use your Mastercard, you could use your Visa, you're going to want to use Mastercard and Visa over something like Amex. This is a shortfall with Amex. Amex has built up a stigma of not being accepted everywhere, right? Because they charge higher fees. And of course, I'm sure many of you guys know because there's like a billion videos on Mastercard and Visa, but they're actually the payment processor. They don't issue credit. So when you like build up interest or when you actually borrow using your credit card and all that type of stuff, it's not Mastercard and Visa that is lending you that money out. It's the actual bank. So Mastercard and Visa is simply the middleman of taking money from your bank and putting it in the business's bank, right? I'm sure literally every single one of you watching knew that fact. And then another interesting feature that Finchat actually has is you could go over here to the dashboard tab. Now with the dashboard tab, this is essentially a portfolio tracker, but something that I love about it is it gives you access to like thousands of different financial ratios and growth metrics and all that type of stuff. So I've already toggled on a couple key trackers of performance that I like to frequently look at. And this way I could see all my different holdings in my investable universe and compare, for example, the forward PE of all my different holdings next to each other. And it's stacked up and neatly stacked right next to each other. So I've sorted by a percentage of portfolio allocation here. And we could see that Mastercard over here has roughly 16.5% free cash flow growth, or I should say cash flow growth, but roughly the same. They have about 16.5% cash flow growth projected for the next 2 years. And of course, this is a very simplistic way of looking at this business, and sure, it doesn't tell the entire full story, but this is roughly in line with historical averages. And to be completely fair, we shouldn't be taking analyst projections at like a absolute level. Like their word is not, like they're very frequently wrong, right? But the reason why I'm choosing to take analyst expectations for Mastercard is because of the predictability of this business. And again, on Finchat, we have this wonderful feature where we could see analyst expectations on the coming 1, 2, 3 years, whatever the case is, right? And the reason why this is important is because, for example, if we click on the revenue tab here, right? We're able to see that in 2024, the lowest end analyst is expecting just shy of $28 billion in revenue. And then the high-end analyst is expecting about $28 billion in revenue. To give you an idea, we could even run the calculator here. That lands you at like 2% difference between the low-end and the high-end analyst, right? About a 1% difference, right? There's about a 1% difference in revenue projections between the lowest analyst, the most bearish analyst on Mastercard, and the most optimistic analyst on Mastercard, right? So a 1% difference in revenue. And to give you an idea, let's just go to, for example, AMD, right? AMD, the company we were looking at, the most expensive company in the S&P 500 on PE ratio. And we could look at the revenue disagreements on AMD. It starts out about 24 and 27.5 billion, but even we could go a little bit further. Let's just say 2026. The low-end analyst is expecting about $25 billion of revenue. The high-end analyst is expecting 45. So that's what, like a 70-80% disagreement? So, I mean, me personally, if the projections that I'm building out for a company is, sways by roughly 70-80%, I'm willing to pay a drastically different price if one of those two outcomes comes true. So this is just to kind of give you an idea. Again, if we go back to Mastercard, you could see that even in 2026, the variance in the low end and the high end estimate are roughly no difference at all, right? So this is why I'm actually choosing to take analyst expectations, because Mastercard is an incredibly predictable business and analyst expectations actually make sense in this case. And so jumping over to my valuation spreadsheet, which I like to include in all my videos, long story short, we're taking the current valuation of the business and we're dividing it by how fast we expect that company to grow at. So in the case of Mastercard here, as we just saw about a second ago, we have roughly a 31 times price to free cash flow. This is on a forward basis. So for the next 12 months or the next 4 quarters, it's trading at roughly 31 times price to free cash flow. And then we just saw that it's roughly a 16.5% free cash flow growth rate for this business. So that lands it at, in my books, being undervalued for the amount of growth that it's providing. And then on top of that, we could actually directly compare Mastercard to the S&P 500 because I've actually put the S&P 500 into the spreadsheet over here. So we can see that SPY is also trading at roughly a 31 times multiple, but you would notice that the amount of growth that the S&P 500 is actually providing is significantly less than Mastercard. So what you have is 2 options here today. Sure, we went over the S&P 500, how you could invest on that path, but you also have the opportunity cost of building out a Mastercard position. And as I've proven to you over the course of this video, we have Mastercard, which is an extremely predictable business with an incredibly wide moat, trading at the identical valuation that the S&P 500 is trading at. So today you have the option of investing in the S&P 500 and earning 10% free cash flow growth there, or for the identical valuation, investing in Mastercard and experiencing a 16.5% intrinsic value growth on that front. And how does Visa stack up against this? I've actually put Visa in here as well. Again, if we go over back to Finchat and go into the dashboard feature, you'd be able to see that I've put Visa in here as well. The cash flow growth rate for Visa is about 11%. I'm being a little bit more optimistic and saying that Visa is going to grow at about 13%. I'm just saying, you know what, let's put like a 2% buyback on top of that. And even despite that, you could see that for the amount of growth that Visa is providing, it doesn't trade as cheaply as Mastercard. Mastercard, for the amount of growth that it's providing, you are getting a significantly cheaper valuation on a valuation to growth basis, that is, of course. And even if we wanted to include roughly a 2% buyback, right? I mean, we did it for Visa. It's only fair we do it for Mastercard. You'd be able to see that it becomes even cheaper. It becomes as cheap as Ulta Beauty, at least based on this framework that we're working on here with comparing the valuation you're paying to the amount of growth that it's providing, right? So give or take, Mastercard is undervalued to deeply undervalued. And so to kind of wrap up the video, don't be scared of investing at all-time highs. The worst case scenario is that you experience losses for a couple years. But I mean, if you're a long-term oriented investor, you shouldn't be worried about the next year's return or even the year after that. You should be spanning out at least 5 years. Look at the 5-year. Because in the short term, the markets are a voting machine where people are voting on the stock price movements. I'll pay another $10 on Nvidia because in the short term, the S&P 500 is a voting machine. People are voting and bidding on the price that they're willing to pay on all these different businesses. But in the long term, the markets are a weighing machine. They're weighing how much cash flow is this business producing today and how much cash flow is it going to be producing and how fast are those cash flows expected to grow at. That is the long-term way in which stocks will continue to go up. This is not an opinion. This is a fact that is echoed by many great investors of the past. So in conclusion, don't be scared of all-time highs. Be excited. And you don't have to always invest in the ETFs. There is plenty of opportunity as long as you're willing to turn the stones and look at these different businesses, and particularly looking at how much growth you're getting for the valuation you're paying. And at last, if you like the fact that I don't waste your time, you should consider hitting the subscribe button because I'm going to continue to post high quality videos just like this one. And you can always go back on that decision if you end up not liking the videos, but I highly doubt that. Also, a reminder that you could check out Finchat absolutely for free with no obligations using the first link in the description down below. Thank you for watching and have a great day.